In the beginning, there was no money. People traded goods and services directly. This system is called bartering. A farmer might trade a bushel of wheat for a pair of shoes from a cobbler. Bartering worked well for small communities, however, it had limitations. Finding someone who wanted what you had and had what you wanted was challenging. Gradually, people began using commodity money. This meant using items with intrinsic value for trade. Examples include shells, beads, salt, livestock, and grain. These commodities were more durable and divisible than other goods. They could be stored and transported more easily. This made trade more efficient. Commodity money was a significant step forward. However, it still had drawbacks. For example, the value of commodities could fluctuate. A drought could make grain more valuable, disrupting the existing trade system. The need for a more standardized and reliable form of money became apparent. This need led to the development of coinage. The use of coins marked a significant turning point in the history of money. Around the 7th century BC, the first coins appeared. These early coins were typically made of electrum. Electrum is a naturally occurring mix of gold and silver. The Lydians in modern-day Turkey were among the first to mint coins. They stamped their coins with images and markings. This practice standardized their weight and purity. Coins were revolutionary. They were durable, portable, and divisible. Their value was consistent and easily recognizable. This facilitated trade and economic growth. The use of coins spread rapidly throughout the ancient world. Precious metals, particularly gold and silver, became the standard for coinage. For centuries, coins dominated the world of money. Then, paper money emerged in China during the Tang dynasty around 618 to 907 AD. Early forms of paper money were essentially promissory notes. Merchants used them to avoid carrying heavy strings of coins. These notes promised to pay the bearer a certain amount of silver or gold upon demand. By the 11th century, the Song dynasty in China issued the first true paper money, known as jiaozi. This marked a significant shift from commodity-backed money to fiat money. Fiat money derives its value from government decree rather than any intrinsic value. The rise of paper money was intertwined with the development of banking. In medieval Europe, banks emerged to facilitate trade and lending. Merchants deposited their coins with goldsmiths for safekeeping. The goldsmiths issued them receipts. These receipts could be exchanged for the deposited coins. These receipts gradually evolved into a form of paper money. People began using them to make payments rather than withdrawing the actual coins. Goldsmiths realized they could lend out a portion of their deposits to earn interest as long as they had enough coins on hand to meet withdrawal demands. This practice was the forerunner of fractional reserve banking, a system that underpins modern banking. The development of banking and paper money led to the establishment of central banks. These institutions were tasked with regulating the money supply and ensuring financial stability. The Bank of England, established in 1694, was one of the first central banks. In the late 19th and early 20th centuries, the gold standard became the dominant monetary system. This system pegged the value of currencies to a fixed amount of gold. The gold standard aimed to provide stability and prevent inflation. However, it also limited the ability of governments to control their monetary policy. The latter half of the 20th century witnessed a move away from the gold standard. Most countries adopted fiat currencies. These currencies are not backed by any physical commodity. Their value is determined by market forces and government policies. This period also saw the rise of credit cards and electronic payments. These innovations further reduced the reliance on physical cash. The early 21st century ushered in the era of digital money. Cryptocurrencies like Bitcoin emerged as decentralized digital currencies. They operate independently of central banks and governments. Bitcoin transactions are recorded on a public ledger called a blockchain. This technology ensures transparency and security. The rise of cryptocurrencies and other digital payment methods has profound implications for the future of money. Central banks are exploring the possibility of issuing their digital currencies, known as central bank digital currencies or CBDCs. CBDCs could offer benefits like increased financial inclusion, faster transaction speeds, and reduced costs. The future of money is likely to be digital, decentralized, and driven by technological innovation. Cryptocurrencies, CBDCs, and other emerging technologies have the potential to revolutionize the financial landscape. They could reshape how we think about and interact with money. The evolution of money is an ongoing journey. It will be fascinating to witness the next chapter in this long and fascinating history.